presentation. I'm Michael Kapinski, the Director of Research and also the Media and Entertainment Analyst. And it's my pleasure to be able to introduce Chris Young. But before I do, I wanted to mention that Entravision is one of my favorite stocks. Currently, you can get my research off of channelcheck.com. But let me just a little. Okay, tell me what I'm doing. Turn it on.
Is it on?
Turn it on. Okay, well that helps.
Then there was light.
Miracles. Entravision is one of my favorite stocks. I think investors have not caught up to this story. And the story here is that Entravision is transformed from just a legacy media business to a digital media business. And Chris is going to talk a little bit about that. But what's interesting about the stock valuation is that, around 5.5 times enterprise value to cash flow, it's currently trading below many of its media legacy type broadcast peers. And whereas, as I just mentioned, this digital business is growing quite rapidly, and Chris is going to talk a little bit about that. So I really encourage you to kind of get your underneath the story here. I think at some point we'll start to see some multiple expansion given their attractive digital media businesses. And with that, I'll turn it over to Chris Young.
Thank you, Michael. Thanks for having us here at the NobleCon18 conference. You don't need this microphone. Here, why don't you take that back? Yeah, thanks. Thanks, everybody. Thanks, Michael. So I just found out that I have 20 minutes to go through a 45-minute presentation, so I'm going to ad-lib here a little bit. Really, I'm here to drive home the transformation that Michael's been talking about as far as our operations are concerned, what we've been going through over the past couple of years, particularly post-COVID. So I'll spend a little less time on our legacy operations, which is by definition broadcast, radio, and TV, a little more time on our digital operation, because that's what's been driving our growth as of late. So with that said, please take note of our safe harbor. I will be making comments about the future, no reps or warranties with respect to the accuracy of those comments. So we always like to start off with a map. The map that I used to show to kick off this presentation was a map of the United States and where our TV stations were. Now, it's a map of the world, and really, I think it speaks volumes about what we've been up to over the past couple of years. The good news, the first takeaway about this map is where we're not. We're not in Russia. We're not in the Ukraine. So we'll start there and move on. But importantly, we have been going through an expansion effort, particularly throughout Latin America and through Southeast Asia, and most recently in Africa, and I'll talk about all of those coming up here. By the way, so we've got 1,100 employees globally. Let me put that into context. 5 years ago, we had approximately 1,200 employees with our U.S. broadcasting operation. Today, that looks more like 600 employees. The balance of those employees are now part of our international digital operation. So that gives you an idea of the transformation that we've been going through. And now we operate, as opposed to just here in the United States, in 34 countries across the globe. And here's a timeline of our story. We were founded back in 1996 as Univision's largest affiliate group in the broadcast arena. We went on to acquire TV and radio stations. We went public in our own right in 2000. And then in 2014, we started getting into the digital business through a series of acquisitions, Pulpo, then Headway, and then 2018 we bought Somatics, and I'll talk about Somatics in a minute. And then most recently, Cisneros Interactive, Media Donuts, and 365 Digital, which got us a beachhead on the African continent selling digital advertising, which we're really excited about. I won't touch on all of these points, but these are the investment highlights of our story. We are in high growth mode. We had some great numbers to talk about last year. We think we're going to have some great numbers to talk about in this coming year. All the while, we think we have one of the best balance sheets in the media business. Our net leverage is close to zero if you net our debt against our cash. We've got a great free cash flow generation as far as percentage of EBITDA. And we're basically excited about the future. We're guided by a team of managers that has been with the company on average over 20 years. And there are all of our pretty faces. Like I said, we've all been around the company through recessions and now COVID, and we've all got different playbooks for different scenarios. So you have a safe pair of hands guiding this operation. The most recent addition to our group is Juan Saldivar. Juan is our Chief Digital Strategy and Accountability Officer. Juan is really heading up our digital efforts globally, and he's made a big difference, and I'll get into what that difference is in a minute. So let's just break out our operating segments by division. So let's talk about digital first. So in 2021, our digital division spanned 34 countries, and it generated $555 million in revenue overall. Compare that to our TV division, generated $147 million in 2021 revenue. And really that's coming off of the affiliations of primarily Univision and Unimas. But we do have some Fox affiliations as well as an NBC affiliation in Palm Springs. And then our audio divisions, 46 radio stations across the country, generated $58 million in 2021 revenue. So I think this graph here speaks volumes about how far we've come as far as an operation to have a little more than $500 million of revenue, 75% of our revenue coming from the digital division. I don't think anyone was expecting to see that 5 years ago. So let's talk about what our digital segment means. First and foremost, there is an acquisition that I mentioned earlier called Cisneros Interactive. Cisneros is in the business of selling advertising on behalf of what is now Meta, what was formerly known as Facebook, Spotify, and LinkedIn. They focus on markets primarily throughout Latin America. This is an area of the business where the likes of Facebook have opted to have their sales efforts outsourced to a third-party company throughout Latin America, and we are that third-party company. We like the business because this is an area of the world that is economically less mature than the United States. The consumption patterns of Facebook is very different than what we're seeing here in the United States. They're about 5 years behind as far as Facebook's progression digitally is here. And we like where we are in Latin America. We like the way Facebook is being consumed. It's still in extremely high growth mode. This was an acquisition that we did several years ago. They were cash flowing about $10 million annually. They're doing well north of $30 million now. It's just been really explosive growth, and we haven't had to make any acquisitions to achieve that growth. So when Cisneros really started to perform, we took a look at that business model, sales representation. It's a pretty straightforward business model. And we started to think to ourselves, well, geez, if this is going so well here in Latin America, where else in the world can we take this model and run with it? And that brought about the opportunity known as Media Donuts. Media Donuts is the same exact type of business. They sell advertising on behalf of global platforms. With the exception of instead of selling on behalf of Facebook, Media Donuts is out there selling advertising for TikTok, for Twitter, for Spotify. Same business. They go out, they have these relationships with the local agencies, they generate advertising for these platforms, and they get paid for them. It's been really exciting to watch Media Donuts grow. What Entravision brings to the table when we make these acquisitions is infrastructure. We bring in the accounting infrastructure, we take over HR, take over payroll. This allows the proprietors to just focus on sales. And what we're noticing is as they focus on sales, they really drive sales. And again, it's been a win-win approach to our overall expansion. So as the Media Donuts transaction began to do very well, we started looking elsewhere, and that brought us to Africa, of all places. 365 Digital is a deal that we did back in November of last year. Really, if you want to think about 365, you think TikTok on the African continent. It's the first exclusive sales arrangement on the continent, and we're excited about it because what it does is it brings an exciting platform onto a continent that really hasn't even begun to explore the possibilities as far as the platform is concerned. Interestingly, Anzu, which is on this graph, 365 Digital had, Anzu is a company that places advertising within games. If you're, walking throughout a landscape and there's a billboard in the game, they sell the advertising that goes on that billboard. Anzu is It's an Israeli company. They were excited about the prospects of us coming on board as far as Africa is concerned. We just did a press release the other day announcing that we are now launching a sales rep deal for Anzu throughout Latin America now. So we're taking an existing relationship with 365 Digital and we're expanding it to a different part of the globe through another one of our subsidiaries. So just an idea of what can be done when you start to cross-pollinate these various client relationships. Somatics is an interesting play as well. Somatics is a proprietary DSP, mobile first. They have been huge in the gaming business. They go out, user acquisition DSP. Gaming companies love it because of the ROI they get. And Somatics is, again, it's based in Barcelona, and they've really only been focused on sales throughout Spain and the United States. This is a company that we acquired 5 years ago. It was doing about $5 million of revenue. They just punched through $50 million of revenue this year. And we think their growth prospects are significant. To grow 10x in 5 years is pretty impressive. And what we're doing also is launching sales efforts across all of these different regions of the globe where we now are and getting the Somatics platform in front of our existing clients in those regions. So again, really interesting growth prospects for this operation. And here this kind of encapsulates how we think about our digital division really in 4 different areas. Global commercial digital partnerships, programmatic marketing relationships, digital audio, and then lastly, branding and mobile performance solutions for our clients. And that's primarily working with local mom and pop advertisers here in the US who are predominantly or historically buying advertising on our broadcasting operations. We help them out with the digital campaigns. And here's a graphic of what we've been able to achieve revenue-wise as a result of this expansion effort. I think it's pretty self-explanatory. It's been pretty explosive growth. And we expect that to continue. So, like I said, we're going to cut this down a little bit. I don't think I really need to talk at length about our TV segment, but let's touch on a couple issues. This is a slide I used to show at our conferences here. Obviously, our TV stations are in high-density Latino markets. This is how we got our start. It's our foundation business. It's going to continue to be our foundation business, but quite frankly, it's not going to drive growth going forward. It's a high cash flow margin business. And look, it's still a great business to be in. It's just not where we're focused on as far as M&A is concerned. And Univision is still the big kahuna in the Spanish language TV world. They've got approximately 66% of the Spanish language viewing in our markets. Telemundo's number 2 with 29.8%. We do local news. Again, I'm not going to spend too much time on local news, but it's something that we do and we do well. Well, let's talk briefly about our audio segment. 48 stations across the country. We've got network affiliates in addition to those O&Os, an additional 316 stations. We've got our own content that we've homegrown. We market and distribute that content both over the air and digitally through podcasts and streaming. And then we've got that across a handful of networks nationwide. A buyer can reach 95% of Latinos here in the United States with one buy at Entravision. That's a key point, one-stop shopping. So these are some fun slides. As a CFO, I like to spend some time on. But here's the evolution of our revenue since 2019, the last year before COVID hit. We were back in 2019 a $273 million revenue company. This past year we finished at $760.2 million. Our adjusted EBITDA went from $41.2 million to what we were impressed with in 2020 was a $60.4 million EBITDA company. We made, just to go back a bit, in response to COVID, we made about $20 million of expense cuts. in our broadcasting business. Well, really across the board, but primarily within our broadcasting business. That enabled us to right the ship as far as the environment was concerned. And the reality is the majority of those cost cuts are permanent. And so we are now leaner and meaner as we creep out of COVID and get back to a more normalized operating environment. And then in 2021, we did 88 million in EBITDA. So it's a nice progression since the last year before COVID to where we ended up in 2021. And I think Mike's not here, but I think he's got us at 93 million in estimated EBITDA for the year. And let's just talk about the digital contribution of that EBITDA growth. So if you look back here in Q4 of 2019, right before COVID hit, we were doing about 1.7 million of EBITDA from our digital business. In Q4 of 2021, we did 11.5. So that growth is pretty self-evident. In 2019 as a whole, for the entire year, we were a break-even organization as far as our digital contribution was concerned for EBITDA. Now they did close to 28 million in 2021. That's only going to continue to grow. Free cash flow went from 8.3 million in 2019 to 43 million in 2020 to close to 79 million in 2021. We've got we are not a capital intensive business. We pay around 3%, it's a floating rate instrument, around 3% for our debt. At some point in the near term, we'll be refinancing that debt and interest rates will go up. I think that should be baked into everyone's model. But the bottom line is, because we're a low taxpayer and because of the low interest rate environment and because we have de minimis capex, we're able to convert a significant portion of our EBITDA generation into free cash flow, much more effectively than most other media companies that I'm aware. And I touched on briefly the balance sheet. This is where our balance sheet stood as of December 31st. We had 185 million of cash on the books. We had 212 million of notes and about, call it $2 million of additional ancillary debt. Total debt of 214 million. Net debt against our total cash, and you've got net leverage of 0.3 times. You've got a growth company that's been growing by leaps and bounds, and you have a balance sheet that is as pristine as I think there is in the business. So we're pretty pleased with it. I think what this also speaks to is there's room for growth here as well. If there are acquisition opportunities, you've got cash, but you also have the capacity to put on a little more debt if you find something really interesting. And that gives you an advantage in a marketplace if you're competing for something, an asset that's pretty compelling. So with that said, and we've posted this on the website, on our website. In the back, I've got all kinds of crazy data, so I'll just flip through it real quick. But you've got growth drivers. It's a political year. We will do significant amount of political this year in the midterm elections. California by itself is going to be interesting simply because they've got some initiatives that are on the ballot as far as gaming is concerned, online gaming. That's going to be an interesting prospect for us. California is a big operation for us. Texas is going to be a competitive political environment as well. And again, I'm just flipping through a bunch of data, but you can pick up all of the data that's in our appendix on our website. So I may have gone too fast through this process, but I'm done. So with that said, why don't I take any questions that you may have out there? And I'll go to, let's keep it on. That's a good graph to leave it on. Questions? Everyone's processing. Our debt matures in November of 2024. That is a term loan B that was agented by Bank of America. The market for a debt refinancing is there if we wanted to go now, but I don't need to go now simply because I've got another couple of years. But generally you want to go out in front of that with some cushion just in case. So we're watching the debt markets very carefully. And when markets, a part of this is the uncertainty attributable to the war in Ukraine. So, depending on how that war progresses or doesn't, that'll dictate, the timing of our debt refinancing. So, we did the debt deal back in 2017. It was a 7-year term loan B facility. And back then, it was a $400 million facility. So it goes to show we've been aggressive about paying down the debt, and we're in a great place as far as, our cash position versus our debt, overall debt is concerned. So we're pretty pleased about that. But again, we'll be going back to market at some point in the near term to refinance it, push it out maybe another 5 or 7 years, depending on what options we want to take advantage of as far as what the debt market is, facilitating. Yes, sir.
You spoke of the course of those 3 years, 1921, so your even margins went down slightly.
Yeah.
What were the costs that were?
The EBITDA margins have been dropping because as we morph into a digital business, look, television is a wonderful business. It's also from a cash flow margin business, mid 40%. Radio is also a wonderful business. Cash flow margins wise, it's a mid 35, call it 35% margin business, both wonderful businesses, but they're not growing. The digital business, on the other hand, is a growing business, but the margins are much thinner, right? So that's been driving the overall blended average margin of the business downward. As we get more into the digital side of the business, our net cash flow margins have been coming down. But the goal is to get our net cash flow margins overall from our digital division. Last year we finished at 7% cash flow margins. The goal is to get that, closer to 10% over the next, call it 12 to 18 months. But that's the reason for the decline in the blended average. Good question. Yes, another question.
Yes, what's your strategy with content creation, production?
Content creation and production, our strategy. So for television, the only content that we produce is our local news. We monetize that as many ways as we can. For radio, we produce a content every day that goes on the air and that's also distributed via streaming, via various different ways. So that's pretty much it. So we don't have an ambition to get more into the content creation business for television distribution or for streaming per se. That's just not what we do. We see ourselves as a sales rep firm. We are in the business of connecting advertisers to consumers, whether it be through brands like Univision or Unimas or our various radio networks or Facebook or TikTok. That's the business that we're in. We're the facilitator of that transaction. So the content business, as we all saw the Netflix numbers the other day, it's a tricky business, and that's never been our strength, and it's never been our core strategy. We like to keep things simple, easier to understand. Anybody else? Yes? Can you stop and start again? I couldn't hear the first part, yeah. Sorry.
No, I saw that you started a $3 million last year buyback program.
Yes, the buyback program, yes.
Are you guys, if you are thinking of balance sheet, do you guys considering doing any other programs to give impact money to shareholders?
Sure, so the question is giving capital, repatriating capital back to shareholders, how we're going about it. We do have a $20 million board-approved buyback program that is in place. It has been active. We cut our dividend in half in response to COVID a few years ago, and we've not been back to reinstating that dividend policy. What the board does every quarter is have a conversation about options. And I think right now the decision that they're relying on is, there are acquisition opportunities out there. We really don't need to be paying a dividend at this point. We want to go out and buy value that's accretive, and that equation falls into buying back our shares, which we believe are undervalued. And so that's where we are today, but the board will revisit its dividend policy every quarter. And when they make a decision, we'll all know. Anybody else? Well, thank you for coming. Thank you for your time, and we're done. Thank you.